Good afternoon. My name is Deidre, and I will be your conference operator today. At this time, I would like to welcome everyone to the Mylan fourth quarter and full year 2018 earnings conference call and webcast. All participant lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question at that time, please press star 1 on your touch-tone phone. In the interest of time, we ask that you please limit yourself to one question. If you need to ask further questions, you may re-enter the queue. Lastly, if you should need operator assistance, please press star 0. Thank you. I will now turn the call over to Melissa Trombetta, Head of Global Investor Relations. Please go ahead.
Thank you, Deirdre. Good evening, everyone. Welcome to Mylan's fourth quarter 2018 earnings conference call. Joining me for today's call are Mylan's Chief Executive Officer, Heather Bresch, President, Rajiv Malik, Chief Commercial Officer, Tony Morrow, and Chief Financial Officer, Ken Park. During today's call, we will be making forward-looking statements on a number of matters, including our financial guidance for 2019. These forward-looking statements are subject to risks and uncertainties that could cause further results or events to differ materially from today's projections. Please refer to the earnings release we furnished to the SEC on Form 8-K earlier today, as well as our supplemental earnings slides, all of which are posted on our website at investor.mylan.com for a further explanation of those risks and uncertainties and the limits applicable to forward-looking statements. Mylan routinely posts information that may be important to investors on this website, and we use this website address as a means of disclosing material information to the public in a broad, non-exclusionary manner for purposes of the SEC's Regulation Fair Disclosure, Reg FD. In addition, we will be referring to certain actual and projected financial metrics of Mylan on an adjusted basis, which are non-GAAP financial measures. We will refer to these measures as adjusted and present them in order to supplement your understanding and assessment of our financial performance. Non-GAAP measures should not be considered a substitute for or superior to financial measures calculated in accordance with GAAP. The most directly comparable GAAP measures, as well as reconciliations of the non-GAAP measures to those GAAP measures, are available in our fourth quarter earnings release and supplemental earnings slides, as well as on our website. Let me also remind you that the information discussed during the call, except for the participant questions, is the property of Mylan and cannot be recorded or rebroadcast without Mylan's express written permission. An archived copy of today's call will be available on our website and will remain available for a limited time. With that, I'd like to turn the call over to Heather.
Thank you, Melissa. Good afternoon, everyone, and thank you for joining our call. First and foremost, I'd like to thank my colleagues around the globe. Mylan has made tremendous strides in 2018 in delivering on our mission to provide the world's 7 billion people access to high-quality medicine, and all the credit goes to our hardworking and dedicated employees. Together, we have launched biosimilars in key markets, progressed several scientific programs, overcome regulatory hurdles, and continue to advocate for policies that break down barriers to access, just to name a few. We've also said many times before that Mylan's business model is built on diversification across our commercial, operational, and scientific platforms, making us resilient but not immune to macro industry dynamics and changes within healthcare systems around the globe. Realizing this, we have focused on our investments in strategic execution, which have yielded a diverse and differentiated business platform. We believe with this diverse platform, we'll be able to continue to deliver superior returns over the long run. Today, 64% of our total revenues come from outside the United States, and as far as our product mix, U.S. generics make up less than 1/3 of our portfolio. With that said, even in light of the current industry environment and conditions, our results in 2018 were strong. Our 4% decline in total revenues and flat year-over-year adjusted EPS reflects solid execution for Europe and Rest of World segments, helping to offset the volatility in our North America segment, where net sales were down 18% year-over-year, impacted largely by 3 factors. First, we experienced slower than expected uptake of our generic Copaxone, even after reducing the price by more than 60%, which perfectly illustrates the current distorted financial incentives within the specialty pharmacy marketplace. That said, we adapted and recalibrated and are now seeing improved pull-through of our glatiramer acetate. Second, approval of generic Advair did not occur in the timeline we had anticipated, but the good news is we received it early in 2019. While we're also seeing misaligned financial incentives for complex products in the retail pharmacy space, we were able to apply our learnings from generic Copaxone and adopt a unique launch strategy with Wixela. I'm pleased to report that we've received a positive response thus far. And lastly, we've rationalized a significant portion of our commodity generics business. After reflecting on the accomplishments of 2018, it's becoming more and more apparent that one of Mylan's greatest strengths is the incredible agility it's created throughout the company. This clearly is one of the core strengths in executing against our strategy. Our strong execution and the results of our performance reflect our continued ability to adapt quickly and strategically to market conditions, while at the same time we remain committed to being a leader for the generics industry and advocate for changes to the current structural issues in the U.S. healthcare system that hinder access to generics. To that end, we are extremely encouraged by recent proposals by the administration in the CMS call letter that strive to ensure that generic and brand products are placed on proper formulary tiers, incentivizing generic uptake, as well as creating a much-needed generic tier for specialty. We applaud these proposals and look forward to patients benefiting from the system the way that it was intended to encourage generics and biosimilars, one that allows innovation and competition to drive each other, which in turn creates further access to more affordable medicines. Looking ahead to 2019, we feel incredibly positive about our ability to deliver a strong financial performance. Specifically, we expect to generate total revenues between $11.5 and $12.5 billion, which is mid-single-digit growth versus 2018. This guidance reflects top-line growth across all three of our geographic segments, North America, Europe, and rest of the world. And impressively, this growth includes more than $1 billion of new launches, nearly all of which have already been approved. Unlike 2018, this outlook reflects a return to new launches driven by complex and specialty products that we believe will more than offset price and volume erosion. There's been a lot of discussion about whether or not the U.S. generics industry has stabilized. Value has certainly been extracted out of the U.S. marketplace, and that value has affected companies differently depending on their portfolio. From our perspective, the U.S. generics industry is made up of three important and distinct types of products: commodity, complex, and specialty. This distinction is important because the level of investment, uptake, and competitiveness vary significantly across these three groups and have shifted over time. As you can see in our earnings deck on slide 10, Mylan's investments over the last decade are now being realized, and the evolution of our portfolio will deliver over the longer term. We will continue to invest in specialty and complex products, and we see this trend continuing, which will require additional allocation of capital. As our U.S. portfolio has evolved and diversified, so too has our overall global portfolio. The product mix we have today reflects the fact that we don't believe in sacrificing investments for the long term, and 2019 won't be any different. We expect to deliver adjusted EPS in the range of $3.80 to $4.80, representing a year-over-year mid-single-digit decline at the midpoint, which reflects incremental R&D and sales and marketing investments to support current and future top-line growth. In addition, we're looking to generate adjusted free cash flows between $1.9 and $2.3 billion. Switching gears to beyond 2019, I'd like to take a minute to talk about the steps Mylan is taking to transition to a business model that we see predominantly being driven by organic growth. Sustainability cannot be dependent on prior success alone, but requires a company willing to reinvent themselves in order to further build upon that success while keeping pace with the ever-changing market dynamics. With that said, we are driving capital market disciplines down into every segment of our business, distinguishing between value-creating and value-consuming assets. We formalized that work and have stood up a business transformation office that is putting a highly disciplined financial lens to unlock latent value from the assets we've integrated throughout the company. Through this rigorous process, we expect to deliver continued long-term growth and attractive shareholder returns by maximizing new products, reallocating investments to drive share of economically profitable products, all while maintaining a competitive sourcing and manufacturing footprint. We look forward to providing you with the full details of our business transformation roadmap at our Investor Day this fall. And with that, I'd like to turn the call over to Rajiv.
Thank you, Heather. To begin, I would like to provide an overview of our 2018 business results by region. In Europe, net sales totaled approximately $4.2 billion, representing mid-single-digit growth from prior year. The increase was a result of strong performance of our brands, including Creon, Dymista, and Influvac, each with double-digit growth, new product sales, and the favorable impact of foreign currency translation. In the rest of the world segment, net sales totaled approximately $3 billion, an increase of 7% from the prior year, including headwinds in the foreign currency translation. This increase was primarily the result of new product sales across the region, strong performance of our ARV franchise area, whereas Japan, Australia, and China also showed strength on higher volumes of existing products. Our business in North America had net sales of $4.1 billion, a decrease of 18% from the prior year. This was primarily impacted due to the lower than anticipated uptake of generic Copaxone and delayed approval of generic Advair. As part of our Morgantown remediation and restructuring activities and accelerated commoditization of oral solids, we discontinued almost 250 SKUs of highly commoditized oral solid products. North America benefited from some exciting launches of Fulphila, Daptomycin, and exclusive 180 days of Tadalafil, and full-year impact of generic Copaxone. I will now address Morgantown plan. After the April 2018 inspection and receipt of a 483 form, the company took a comprehensive restructuring and remediation of the Morgantown plant to address the issues that had been identified. Notwithstanding these efforts, the company received a warning letter related to the previously disclosed observations in the fourth quarter. The issues raised in the warning letter are being comprehensively addressed. The Morgantown plant continues to supply products for the U.S. market while we execute on and assess the restructuring and remediation activities. No significant new product revenue is forecasted from the Morgantown plant in 2019. Also, we look at our business in North America, only 5 of our top 50 gross margin generating products are currently manufactured in Morgantown. We remain committed to maintaining the highest quality manufacturing standards at our facilities around the world and to continuous improvement in a time of evolving industry dynamics and regulatory expectations. Now I will focus on 2019 and our outlook for the year. 2019 will be a significant year from the new product launch perspective, and we are uniquely positioned to add approximately $1 billion in new product revenue. Almost all of our major products driving 2019 growth are either already launched or approved around the world. Also, no product is forecasted to make up more than approximately 3% of global revenues, including our EpiPen franchise. In North America, we are incorporating all of our recent learnings, including the relatively slower uptake and conversion of more complex and specialty medicines, and are adapting to accommodate the changing needs of the market. The high single-digit revenue growth we expect in North America is largely driven by complex and specialty and biologics, including a steady and continued uptake of generic Copaxone share, building further upon the successful launch of Fulphila in 2018 as we expand our biosimilars portfolio for the U.S., extending our respiratory portfolio with the launch of our NCE Yupelri, and most importantly, a unique and patient-centric launch of Wixela InHub where we have a first-to-market opportunity. Also, the impact of volume loss due to portfolio rationalization of commodity products undertaken in 2018 will be largely behind us. To elaborate on Heather's comments on slide 10, you can see a year-over-year decline in commodity product revenues as we evolve our business to benefit from the strength and anticipated growth of complex specialty and biologics products. In Europe, we see mid-single-digit revenue growth driven by a diverse mix of brand, generic, and OTC portfolio. Focused selling and marketing investments on key brands like Dymista, Creon, Influvac, and Betadine will continue to be an important driver. Some other key drivers of European growth will be continued uptake of generic Copaxone, biosimilars like Hulio, a biosimilar to Humira, and Ogivri, a biosimilar to Herceptin. In the rest of the world, we see mid-single-digit revenue growth, largely driven by double-digit growth in China and Brazil, while Australia, Japan, and our ARV franchise will continue to perform steadily. Biosimilar launches across the region will drive new product revenue. Brands like Dona, Dymista, and Elidel will be another key driver. I would now like to take a few minutes and share a summary of our key scientific and regulatory achievements. And before I begin, I would like to thank my Mylan colleagues for their contributions and persistence to bring these difficult-to-develop medicines to patients and acknowledge our close collaboration with our partners. These achievements have required years of hard work, passion, perseverance to bring these alternative options to patients who need these products. A series of significant scientific achievements began just over a year ago, starting with the first approval of generic Copaxone 40 mg in US and Europe. A number of biosimilar regulatory approvals around the world followed, including Fulphila, a biosimilar to Neulasta, Ogivri, a biosimilar to Herceptin, Semglee, a biosimilar to Lantus, Hulio, a biosimilar to Humira, and Evami, a biosimilar to Avastin. We now have regulatory approvals for biosimilars in more than 65 countries around the world. We also received FDA approval of an NCE for Revifenacin, our Yupelri inhalation solution, developed with our partner Theravance. This product is the first once-a-daily nebulization treatment for patients with moderate to severe COPD who may benefit from or prefer a nebulized LAMA treatment. We also continue to make advancements for Influvac, our seasonal flu vaccine primarily in Europe. In addition to our trivalent version, we have launched our quadrivalent version, Influvac Tetra, as well as obtained our first pediatric indication. Also, we continue to expand this in other markets outside of Europe, such as Australia and Canada. And last but not the least, US FDA approval of Exela Inhab, the first generic of Advair Diskus. As we understand, because of the significance of this complex generic, FDA took a few more months to conduct a very thorough secondary review and ensure the labeling was as up-to-date as possible. No scientific or significant regulatory issues were raised during this period. These scientific achievements have further differentiated us from our peers and set us up very nicely for growth of complex specialty and biologics products. Moving to our pipeline, we, along with our partner Revance, had an initial advisory meeting regarding our proposed biosimilar to Botox. Based on agency's feedback, the companies believe that the 351(k) pathway for the development of the biosimilar to Botox is viable and provides the opportunity to develop and commercialize the first biosimilar to Botox. Our other key programs, including biosimilars such as Eylea, Avastin, Humira, insulin analogs, and glatiramer acetate once monthly, remain on track. Given the evolution of the U.S. market and dynamics of the commodity generics, we also continue to evaluate our R&D programs, and resource allocation, and from here onwards, will further increase the emphasis on moving up the value chain with a focus on complex, specialty, and biologics opportunities, the NCEs, and brand lifecycle management strategies. Finally, I would like to echo Heather's remark about our focus this year on evaluating our value-creating and value-consuming assets. We have assembled a second-to-none portfolio and a pipeline with commercial assets across the world, and we are very excited to have another look into the businesses and operations so that we can leverage these assets to the maximum and are able to focus on value-creating assets. Now, I will turn it over to Tony to elaborate on some of the details around our investments in our business segments. Thank you.
Thank you, Rajiv, and good evening. I would like to reiterate the confidence you heard from Heather and Rajiv in the overall performance of our business in 2018. I am proud of the many achievements from the past year, including the scientific advancements you just heard about, which have positioned us well for long-term growth. In 2019, you will see our projected revenue growth in the mid-single digits, with 64% of our total revenue coming from outside of the U.S. Driving this growth will be an acceleration of our global key brands across Europe and rest of the world, complemented by a number of critical, complex, and specialty launches in the U.S. As we examine the evolution of our business and look ahead at what it will take to continue our success, we recognize the importance of valuing future potential. As such, we plan to incrementally increase our sales and marketing investments around our complex, specialty, and global key brand products, with the understanding that these products require added attention to achieve their full long-term potential. We are shifting our Sgna spend guidance to approximately 21 to 22% of sales, with the ultimate goal of advancing access for patients while driving profitable long-term growth. I will now walk you through a few of the key drivers and efforts already underway, starting with North America, where we are expecting high single-digit revenue growth in 2019. Earlier this month, we launched Wixela InHub, our generic Advair Diskus, at a price point of 70% below the brand wholesale acquisition cost to ensure savings for patients as well as payers and employers. With a sales force of 150 individuals, we have optimized our market share with our pharmacy partners and are pleased with the early conversion levels. In addition to providing a lower-cost alternative, we are committed to providing patients and healthcare providers with training and education to ensure a seamless transition. The launch of our new chemical entity, Yupelri, is another exciting example of a product that requires a unique focus from a sales and marketing standpoint to help create new demand and address unmet needs for COPD patients. We are pleased to bring this important treatment to the market and anticipate Yupelri will change the paradigm in the COPD space as the first and only once-daily nebulized bronchodilator approved for the maintenance of COPD. Our sales force is actively calling on healthcare providers, and we are pleased with the initial response from physicians and our customers. We feel confident this trend will continue as we progress throughout 2019, and Yupelri meets its full market potential over the coming years. Continuing with the U.S., our oncology and hospital teams have been focused on the successful launch of Fulphila, our first biosimilar in the U.S., and the first biosimilar to Neulasta. We are offering comprehensive patient resources, including a patient-focused call center, field reimbursement support, and a copay assistance program. Additionally, we have a dedicated sales team calling on healthcare providers in clinics and in hospitals. As a result of these efforts, we are seeing an increase in weekly chargebacks and had over 15% of the pre-filled syringe market earlier this month. Lastly, we are pleased with the accelerated uptake of our glatiramer acetate 40 milligram. Over the past months, we have had strategic discussions with our customers, resulting in further collaboration and subsequent changes in plan coverage, increasing utilization by 34% since the beginning of the year. We also continue to see an increase in the use of our outpatient-focused support services offered through our MS Advocate program, including in-home injection trainings with an experienced MS nurse and a 24/7 patient support center. Our new prescriptions now have crossed the 35% market share threshold, and we look forward to continued growth in the coming months. Turning to our European business, we project mid-single-digit revenue growth in 2019. We have been very pleased with the growth of our global key brands, specifically Creon, Influvac, Dymista, and Brufen, which grew double digits on average in 2018. For Influvac specifically, we are the market leader in Germany and France with greater than 50% market share in each country, based on the most recent quarterly data. Additionally, we are pleased with the launch of Toby Podhaler and Toby Solution, following our acquisition last fall, and will utilize our existing commercial infrastructure to promote and grow this product. Looking ahead to 2019, we have forecasted on average a double-digit revenue growth on our key brands as we continue to further invest and leverage our commercial infrastructure of approximately 3,800 sales and marketing employees and focus efforts in key markets such as France, Germany, Italy, UK, and Spain. We had a milestone year for our biosimilars program and are excited to be launching Ogivri, our biosimilar to Herceptin, in many key markets like Germany and France, and will continue to launch in other countries throughout 2019. In addition to this, we remain encouraged about our generic letermovir acetate 40 milligram in Europe. To date, we have launched in 9 countries in this region, and we have plans for continued expansion and expect to more than double our sales in 2019. In the rest of world region, we are forecasting mid-single-digit revenue growth. In Japan, through added sales and marketing resources, we expect double-digit growth in Amitiza and Lipocreon sales. In China, additional resource investment will generate more than 70% sales growth for Sabivo and Eladil, and greater than 20% growth for Dona. In Australia, we will focus on Dymista, projecting to nearly double sales in 2019. Our rest of world sales and marketing team, comprised of 2,800 individuals, is strong and dedicated to growing our business through concentrated efforts in countries through the region. To conclude, we are excited about our anticipated global growth in 2019 and our enhanced investments to maximize long-term results for the future. Our teams around the world are focused and ready to continue executing on our growth initiatives. With that, I'll turn the call over to Ken.
Thank you, Tony, and good afternoon, everyone. I'll take a few minutes to provide a quick overview of our financial results for 2018. For the full year, both total revenues and constant currency revenues of $11.4 billion were 4% lower than the prior year. On a constant currency basis, net sales in Europe, which was up 1%, and rest of world, which was up 10%, helped to partially mitigate an 18% decline in North America. Excluding approximately $258 million related to the Morgantown restructuring and remediation expenses, combined regional segment profitability declined 7% versus the prior year. Europe grew 1%, while rest of world grew 21%. These combined results helped to partially offset a 16% decline in North America, mostly due to lower volumes on existing products, including EpiPen, as well as pricing declines. On a full-year basis, we reported adjusted net earnings of $2.4 billion and adjusted EPS of $4.58, which is within our previously communicated guidance range. Adjusted EPS versus the prior year primarily reflects benefits from ongoing integration activities and lower share count following the completion of our $1 billion share repurchase program in the beginning of the year, offset by the impact of the decline in our total revenues and increased sales and marketing investments. As a reminder, we did not achieve the targets of our Blue Team 6 incentive program, and there was therefore no payout under that program. Adjusted free cash flow for the 12 months ended December 31st, 2018, totaled $2.7 billion. That's an increase of $86 million compared to the prior year and above the high end of our initial guidance range for 2018. The year-over-year increase reflects ongoing improvements in working capital velocity as well as lower capital expenditures. 2018 adjusted free cash flow conversion was healthy at approximately 115% of adjusted net earnings. That's another measure of the strength and durability of the cash flow generating capabilities of our business. During 2018, we repaid more than $630 million of debt, including a 500 million euro note that matured during the fourth quarter. At the end of Q4 2018, our debt to adjusted EBITDA leverage ratio, as calculated under our credit agreements, was 3.8 times and was in compliance with our covenant requirements. On February 22nd of this year, we entered into amendments to our credit agreements to extend the leverage ratio covenant of 4.25 times through the December 31st, 2019 reporting period. These amendments provide us with additional financial flexibility as we manage our capital structure during 2019. This does not change in any way our commitment to our deleveraging strategy or our investment-grade credit rating. This is simply a recognition by our banking group of the dynamic changes occurring within our industry. Even considering the additional investments in Sgna and R&D that we've discussed today, our capital deployment priority remains focused on deleveraging as we've consistently communicated. We now intend to repay more than $1.1 billion of debt in 2019, including scheduled maturities in June and November. This represents an increase of approximately $500 million in debt repayment versus our previous target. We remain fully committed to our investment-grade credit rating and to further reducing leverage as we work towards our long-term average debt to adjusted EBITDA leverage ratio target of approximately 3.0 times. We anticipate that we'll achieve this target through both continued debt repayment as well as EBITDA expansion. Moving to 2019 at a high level, we expect total revenues in the range of $11.5 billion to $12.5 billion, which represents an increase of 5% at the midpoint versus full year 2018. Full year adjusted EPS is expected to be in the range of $3.80 to $4.80. That's down 6% at the midpoint. And finally, we expect adjusted free cash flow in the range of $1.9 billion to $2.3 billion. As you heard from Rajiv, in our top-line outlook, we expect positive volume growth and a significant contribution from new product launches, including Wixela, coupled with the carry-forward impact of generic Copaxone, Fulphila, and Yupelri. These are expected to more than offset the competitive market dynamics in the U.S. In 2019, we're expecting our adjusted gross margin percentage to be in the range of 53% to 54%, reflecting the benefit of new launches and increased volumes, in addition to ongoing benefits from our Mylan integration activities. We also expect global pricing trends to continue to be relatively consistent with what we experienced in 2018. As you can see on the adjusted EPS bridge on slide 14 in our supplemental earnings material that was posted on our website today, we're expecting a positive contribution from sales growth driven by new product launches and volume from existing products, partially offset by pricing. These benefits help fund incremental selling and marketing and G&A investments that support new product launches, as well as geographic expansion of our key global brands in Europe and the rest of the world. In addition, we'll continue to invest in R&D to fund the long-term health of our business. Finally, we expect interest, tax, shares, and FX to have a slightly dilutive impact on adjusted EPS in 2019. The year-over-year increase in our adjusted effective tax rate is due primarily to the implementation of tax law changes in markets such as Sweden and Italy, as well as the full phasing in of the tax law changes enacted in the United States at the end of 2017. For 2019, adjusted free cash flow, we expect to generate between $1.9 billion to $2.3 billion, net of capital expenditures between $250 million and $400 million. The year-over-year decline versus 2018 is primarily driven by the increased investment in working capital required to support our top-line growth expectations in the year, as well as investing in our operational capabilities to support over $1 billion in revenue coming from new product launches. As always, we'll seek to make these investments as efficiently as possible and continue as we move through the year to look for opportunities to maximize our adjusted free cash flow. It's our ability to generate strong free cash flows supported by the durability of our portfolio and the strength of our balance sheet that provides us with financial flexibility to invest in the future of our business. A quick comment on calendarization as you think about modeling. We expect both total revenues and adjusted EPS to be slightly more heavily weighted to the second half relative to 2018 due primarily to higher profitability and timing of new product launches. In addition, we expect Q1 to contribute slightly less adjusted EPS on a relative basis than the prior year. As we've discussed in the last few quarters, we're continuing to evaluate metrics other than EPS that better reflect how we manage and measure the performance of our business. As Heather and Rajiv both mentioned, we've created a formal business transformation office to evaluate value creating as well as value consuming assets. This office will help shape our roadmap going forward and will include leveraging financial systems and generating additional metrics that will help us effectively track our performance against this roadmap as we move forward. We'll update you on our progress on this at our Investor Day this fall. Now with that, we'll open the call up for questions.
At this time, if you would like to ask a question, please press *1 on your touch-tone phone. If you wish to remove yourself from the queue, you may do so by pressing the # key. We remind you to please pick up your handset and please limit yourself to one question. We'll take our first question from the line of Elliot Wilbur with Raymond James.
Thanks. Good afternoon. Question for the team, I guess, with respect to the step-up or elevation in SG&A investment expected relative to historical ranges. It applies something around the order of $250 to $350 million of additional investment in absolute dollars. And, you know, outside of the color commentary you provided throughout the course of your prepared comments, just wondering if you can go into a little bit more detail on, you know, what and where exactly these investments are, and, you know, what do they enable you to do that you're not doing currently, and how do they enhance your long-term growth profile? I mean, do these set you up to bring in more assets like Uprelli and Toby? Just not really sure how to kind of think about this in terms of sort of, you know, how it may change your strategy and some of the growth initiatives going forward.
Sure, Elliot, I'll start, and then anyone on the team that would like to also chime in. You know, I think it's important, you kind of teed it up yourself in your question when you said our historical ranges. I think that, you know, if I go back several years and look at our historical product portfolio, we had primarily generics, a large number of which were U.S. generics, and as, you know, we pointed out on the chart, a large number of those generics were more of that commodity-based product. So if you think about from an SG&A perspective, we had trended on the lower end because those types of products didn't require the sales and marketing behind them. And obviously that's kind of how the U.S. generics industry worked, especially around those commodity-type products. I think that as our evolution from both the acquisitions from Abbott and Meta, which obviously, especially from a Europe and rest of the world perspective, gave us a much larger portfolio around key brands as well as OTC products, you know, those require investment and ongoing investment. So while there's certainly some that we're maintaining because we've had them on the market a while, there's others that we see a value in kind of reinvesting more in because some of these products in other companies' hands weren't getting the same level of investment that we are now seeing kind of fruitful returns from. And then I would say just our evolution in North America, both from that commodity type product into the specialty and complex, as you know, I think as Tony walked through the kind of services and everything that goes around these more complex products certainly cost more. And, then I think last but not least, when you look at things like our UPEL relaunch and products that, were for the first time, you're certainly investing and ramping up that investment before it's paying returns. So I would say that, if I synthesize all of that, it's looking at our portfolio shift, which is certainly responsible for our cost infrastructure shift. I mean, when I look at us amongst our peers, I would still say that this 21 to 22% range is very much on the low end. It's certainly not up there with the typical specialty, which are in the high 20s. I think that we believe, that this 21, 22 range is kind of is our new step-up basis for the kind of investments that we see that, like I said, not just to deliver the revenues for 2019, but certainly beyond, because as we've seen, especially with these complex products, much slower ramp, much longer tail. So, these are products that, as we look at the different regions of the world, much different contribution, but importantly, all driving over the longer term, certainly nothing on a quarter-by-quarter basis. So, I appreciate the question because I think it really gives us an opportunity to make sure people are, really looking at our portfolio correctly, both our diversification in the United States as well as, importantly, our diversification across Europe and rest of world.
Thanks, Heather. And I just might add, Elliot, I think, as Heather outlined, whether it's UPEL in North America, along with biologics, our global key brands in biologics in Europe, and M&Ts and Sabivo and rest of the world, it's about increasing our share of voice, capturing additional market growth, and getting more physician touch points. Really, as we invest in these resources, not just from a marketing perspective, but a selling and resource perspective, it's getting more with more. That's really the opportunity we see ahead of us.
And Elliot, I'll just add, and maybe this is the last comment on this, but you've heard us talk not just on this call, but the last couple of calls about, identifying value creation assets, identifying those things that we want to do slightly differently with them. You can be assured that as we're looking at this incremental investment to support growth in certain products, that we're putting very strong financial analysis around this, and that's been part of what's coming through this business transformation process, is looking at not just what a product contributes at maybe a gross margin level, but what does it take for us to support that product, whether it be in the launch phase or the life of the product. So to add on to what Heather and Tony both said is, you can be assured that we are putting financial disciplines around looking at returns on these investments, whether it be in the area of people or marketing, so we know what we're getting for the money that we do put out there.
And your next question comes from Ronny Gal with Bernstein.
Good evening. Thank you for taking the questions. Just starting with the text, is that fair to say that the new text level you're describing is probably the go-forward text level that we should expect from Mylan going forward? And then just want to ask a little bit about the strategic review. When I look at some of the struggles you had with the financial markets over time, some of that probably is resolvable with a private company. I mean, I'm sure you consider the possibility. How do you think about it? And I'll stop there. Thank you.
So, Ronnie, I'll take the tax question. Look, as I've called out in the comments, there were a couple of statutory changes that happened at the beginning of this year. And as you know, we've talked about the impact of the 2017 Tax Reform Act in the United States and said really what happened to us with all of that is we had a minor negative impact, whereas a lot of companies who were in the U.S. had a bigger favorable impact moving their tax rate down. The minor negative impact that affected us was really due to the minimum tax calculation that didn't fully come into play in 2018, but does come into play in 2019. So to your question of, is this the new rate for us? I think it's probably close to the new rate. We have a great tax team and a good group of people that are kind of always looking at opportunities to evaluate if we can do something slightly differently. But I think that tax rate is probably the right thing to think about for us today.
Yeah, and Ronnie, as far as the strategic committee is concerned, so, as I have said previously, the committee is looking at lots of things and everything, and as you should expect, as they put that note out there, it was to look at anything and everything that could unlock value. And while, I don't want to speak for the committee, it is my understanding that I think they're nearing completion of the review.
And your next question comes from Chris Schott with J.P. Morgan.
Great. Thanks very much. Just two quick ones here. First, we're seeing a wider range of earnings with the guidance than we've seen in the past. Can you just elaborate a little bit more on what's behind this and maybe talk through some of the bigger swing factors in this year's guidance? And the second one, I just want to come back to the Sgna discussion. I guess my question here is, will you be able to evaluate this year if these investments are having the impact you'd expect, or is this a longer-term process that you'll be able to evaluate the spend? And the type of spend coming here, is this spend that you can kind of turn off and on quickly if you're seeing areas this is working or it isn't working? Or should we think about this more about sales rep and headcount that maybe is a little bit harder to scale down if you're not seeing the return? Thank you.
Okay, Chris, I'll start off and then let Ken or Tony chime in. So, I think the wider range, I think, is just reflective of the volatility that we've seen in the marketplace, and I think we're trying to be respectful of that volatility and take, kind of everything in consideration. As I said in my opening remarks, while, we believe our platform has certainly proven to be more resilient, it's not immune. I mean, as we pointed out, our 2018, we were at the lower end of that range, and we consider that to be very strong results in light of the fact that, we didn't get an approval on Advair in the year, and we had, much lower uptake on Copaxone. I think as you look at these opportunities, they're significant movers. They've got significant dollars attached to it. So I think we tried to take a very, balanced and measured approach to how we are weighing all those things in the business to make sure we're kind of putting that right range out there that gives, that right floor. And I think that, as we looked at the business, really, and I look at our year-over-year growth and continuing that revenue growth in all of our segments, it really just came down to making sure we provided those swings for the opportunities and risks that are always associated with the business around the globe. And, make sure that we're putting something in there that we think accounts for the right level of the assumptions now that, we do have Advair approved and how we're thinking about that uptake. And like I said, what we see happening now with Copaxone, it may have taken longer than we wanted to, but as Tony pointed out, we're starting to see, some better pull-through. So, it was really just trying to give, quite honestly, what I think many of you guys have asked us to be mindful of, which is all the moving pieces and parts to these business and giving ourselves, making sure we give ourselves that range and that latitude because of just that, all the moving pieces and parts. As far as Sgna, I guess I would just say, look, as you would assume, Chris, those investments, you don't get a return on investment dollar for dollar in year one, and depending where things are, if it's a new launch like a Yupelri versus, something like a Creon, where we continue to see growth in markets and or Influvac. So we've got some of these global key brands, like I said, that while they've been in the portfolio for a while, we are seeing benefits of investments, and those are happening real time. So, I think it's a little bit of everything. There's infrastructure we're putting in. There are things that we think have a longer-term payoff, and there's also things that we're putting in place that will help us pull through the products we have coming in the pipeline. Because, as you know, we have one of the largest complex product pipelines out there, and so a lot of this groundwork will help us pull through what will be needed as far as services or infrastructure around these products as we move forward with our portfolio mix.
Yeah, I would only add that to your last point about switch on, switch off. Yes, in some of the smaller countries, emerging countries, where we see there are limited period opportunities, we have that ability to switch on, switch off some of those Sgna expenses just because of using some of the contract resources in those countries.
And Chris, look, I think hopefully you hear, as you're listening to all of us talk about the confidence in the business, that really what this comes down to is as we brought these businesses together and we're spending more and more time digging into what's going on in the business and what we have as far as assets, we're excited about the opportunities that we have. And so as we think about investing, as we do anytime we invest, we're going to do it with discipline and thoughts and metrics and thinking about where the money is best, but we feel really good about the position that we have the assets to invest in.
And maybe just to close it out, when we think about the Sgna investments we're making, very strategic from a headcount perspective, but a good portion of the selling and marketing incremental growth we're seeing is going to be just ramping up the advertising and promotion of some of these key assets globally that do have some nimbleness in terms of future spend once we get it to a level we feel like it's grown appropriately.
And your next question comes from Gary Nachman with BMO Capital Markets.
Hi, good afternoon. So regarding the remediation at Morgantown, how far will that stretch into 2019? I want to understand better what's still involved and how long it will persist. And then outside of the issues at Morgantown, have you seen stabilization in the U.S. generic market continue so far into 2019? What sort of base decline there are you assuming in the guidance? Thanks.
So maybe I'll start with the stability in the marketplace. As I pointed out in my opening remarks, I think it's very difficult to look at the U.S. generic market and paint it with one brush. I think, we have said for a while that portfolios are very different, and so each company's intersection with what's happened in the marketplace is going to be very different. There's no question that I think value has been extracted out of the U.S. marketplace, and I think we see that, we've seen that daily over the course of the last several months, especially as you look at consolidation of what's happened with our customers, as well as just, the ramp up of approvals of that 5th, 6th, 7th, 8th generic for products that as we would characterize in that commodity bucket. So for us, we have continued to see this mid-single digit decline or erosion in the business, and we believe, that from our perspective, that is holding pretty steady. We think a driver for that for us, for Mylan, is because as we look at the U.S. generics market, we believe there's 3 distinct buckets. There's the commodity bucket, specialty bucket, and the complex bucket. And each of those require a different level of investment, a different uptake, as well as different competitiveness in the marketplace itself. So, from our perspective, that diversification in the U.S. business has allowed us to absorb a lot of that volatility, but like I said, not be immune to it. And I think that as we look forward, we're kind of still seeing that mid-single digit erosion. I think the biggest difference for us is having the product new launches be able to offset that erosion, and that's really been historically what has meant success in this business. If your new product launches could offset, your volume and price, that's what has made this market, and I don't think that's changed. It's just, I think the hurdles for some of those approvals have become higher, and they're obviously more significant launches. So, that's perhaps a long-winded answer, but I think it's important that we're not just trying to characterize the entire U.S. generic marketplace and all the players, like I said, with one brush.
Yeah, and regarding Morgantown plant, Gary, as I stated earlier, we continue to execute and assess our restructuring and remediation activities at the site through this 2019. And of course, we are focused on meeting our commitments to FDA and as well as our customers. Now, as far as any negative financial impact on the business, I think we don't see that anymore as we go into 2019. As I mentioned, it's I think largely behind us. We continue to supply from Morgantown of key products. We continue, as we said, there's no new big launches or no new launches budgeted in 2019 from Morgantown. And also from the materiality point of view, only 5 out of our top 50 North American products today come from Morgantown.
And your next question comes from Liav Abraham with Citi.
Good afternoon. Just a couple of questions on new product revenues. Can you provide the new product revenues in 2019, the total? And apologies if I don't understand this, but when you talk about $1 billion of new product launch revenues in 2019, is that $1 billion in total or an incremental $1 billion over 2018? And then any additional color you could provide on the breakdown of the new product launch contribution in 2019 would be helpful, either on a product basis or a geographic basis. Thank you.
So, Leah, thanks for the question. Look, the $1 billion is the total incremental year-over-year benefit of new product launches, and it comes from a couple of places, and I'll give you kind of a geographic order of magnitude. We had products that were launched in 2018 but haven't seen their full 12-month cycle yet. So the carryover benefit of those products is a part of the $1 billion that is new product launches until they hit their 1-year mark. So that's great because those products are in the market and we have a feel for how they're doing. Besides that, what I would tell you is that out of that $1 billion, call it somewhere around 3/4 of it is probably in North America, and the rest of it is split kind of evenly between Europe and rest of the world, just to kind of give you order of magnitude pieces there. And then if you want to kind of understand a little bit about the North America piece, it will have a portion of that carryover component, but it also is where we have Wixela, obviously, and that's a significant contributor to new product launches in North America, which once again, approvals behind us, launches underway, and we feel really good about the uptake on that. As far as contributions from these products, we've consistently said, and we're not going to call out anyone individually, but what we've said is these products have tended to contribute, even with our partner arrangements, at or above the Mylan average overall.
And your next question comes from Jason Gerberry with Bank of America.
Hey, good evening. Thanks for taking my questions. I guess just first question on biosimilars. So has the strategy on a product like Fulphila in the U.S. fundamentally changed from last year, where initially maybe the expectation was that GPOs would have driven the pull-through on a product like this, and now the view is that you'll need a sales force, much like the strategy of the Pfizers and Novartises of the world? And then also, can you comment just how to think about the generic Advair launch? Can you supply at least half the market? Do you expect pharmacies to really drive direct switch, and when you have unlimited Part D access? Thanks.
So maybe just to touch Jason on Fulphila, I think, well, first of all, we've had a very focused sales force on that product since launch. We're going to expand it because we see additional opportunities, not just with this particular product in oncology, but a whole breadth of products that we have today and in the future in oncology. So I don't know that the strategy's changed tremendously from that product perspective. We're seeing, over 15% market share growth with that prefilled syringe business. We've been very selective on the customers we went after, and I think we feel very, very good about our performance of that launch and how it's going to flow into 2019. And you'd asked additionally about Advair?
Yeah, and regarding Advair, we have a state-of-the-art dedicated facility which is up and running and producing and shipping the product today. And if opportunity comes, we have enough capacity to supply the market.
And maybe just commenting on your Med D comment, we know 50% of Advair's usages is in the Med D space. I can tell you from products like Glatiramer we launched,
Initially, we're being blocked out of Med D programs. With Wixela, out of the top 10 Med D plans, we have full parity and access on 8 of 10 out of this moment, 2 weeks from launch. So we feel very good about the initial ramp. We feel very confident about our capabilities from a supply and our pharmacy mix that we've got from a customer perspective, and we have high hopes moving forward.
And your last question comes from Umair Rafat with Evercore ISI.
Hi, thanks so much for taking my question. I had one for Ken and one for Heather, if I may. Ken, there's a lot of feedback from Mylan investors on the low end of EBITDA guidance, especially also from the debt investors. So my question to you is this. In 2019, the low end of revenue guidance is actually just about the same as 2018 actual revenues. So in that context, why is the low end of EBITDA guidance so much lower than the actual 2018 EBITDA, especially considering Sgna should potentially be not as much if the revenues are not tracking towards the type of growth they should put up? And Heather, was just curious if you could add some color on a couple of recent departures on the Chief Legal Officer and the Head of Europe side. Thank you very much.
So look, I'll start with the modeling question around Sgna and revenues and EBITDA. But look, it's right now what we're targeting as we go into this year is Sgna at a rate of 20 to 21%, 20 to 21 to 22%. I'm sorry. And as we do that, that clearly is a level of investment on even the low end revenues, where you said they were the same at the low end as what we have this year, but it is an increased step-up investment, so that drives EBITDA a bit lower, and it's very simply that. So now, to your point around, as we move through the year, we'll certainly watch these investments and ensure we're getting back from them what we're expecting to get, and we may pull back a little bit on some of that investment. We may reallocate it somewhere else where we see it taking hold even stronger. But, effectively, I'd say it's pretty, straightforward math that same revenues with a slightly higher Sgna at either point on the range gives you lower EBITDA.
Yeah, and Umar, as far as departures, I guess I'll just start with saying, I think as having, I'll say the longest, which would, I think, fairly be accurate, the longest tenured management team here in continuity, as you know, that's important to us, and we think it's absolutely been one of the important aspects of Mylan's success and, executing on our strategy and, quite honestly, what we have in front of us. As you know, we've had a couple departures, starting with our Chief Legal Officer. I think not only is he just going back to private practice in D.C., but, as we noted, we're going to continue having a relationship and advisory capacity, so that's just kind of in the normal course. And as far as others throughout the organization, as you can imagine, we've got over 30,000 employees, and we have a lot of people coming and going. I think, certainly, like I said, when you look at the top level of this executive management, we've been the longest tenured out there, and that's very important, and we've built a lot of great bench strength under us. So the exciting news is there continues to be great opportunities for our current employees, as well as, we're always looking at balancing that with bringing in new talent and new perspectives. So I couldn't be more excited about the team we have and the opportunities to bring some new hires in. So thank you. Thank you for asking that.
This does conclude today's Mylan fourth quarter 2018 earnings call and webcast. Please disconnect your lines at this time and have a wonderful day.